Welcome to the Daily Market Wrap once again, Tuesday, 9th of June. We've got Keir here today filling in for Jack. So overnight, Keir, light news yesterday. So everyone's sort of just looking forward to the CPI and PPI later this week.
Yeah, there really wasn't much out. Nothing that could give you any kind of gauge about where the market's going to head. I think it's Thursday morning our time, there's CPI and PPI coming out, maybe the next day. That'll give traders a bit more market direction, but until then, don't really expect any move to really mean too much this week.
And a bit of a change for oil, so fairly steady overnight after Israel and Iran agreeing to end attacks. Again, I think, like we've seen, it's maybe like that for a day or two. But
yeah, it's been like that for a little while. I mean, it's kind of been a day on, a day off. Israel stopped bombing. They're the ones that have kind of kept the fire going for quite a long time. So the fact that they're holding off is significant, I think. But obviously the market's got a fair bit of fatigue around this, so we'll wait and see. The default mode at the moment is they think there's going to be a kind of a limp into an agreement of a ceasefire sometime this month, but I guess we'll wait and see. But I mean, Israel not firing is a good thing.
So we're starting to see, we're starting to see the markets become a little bit desensitised to announcements around oil.
Very much so. I mean, I think unless it's some sort of concrete arrangement, nothing's really going to sway the market itself now. It's had so many days of will they stop fire, won't they stop fire, that it's just, the volatility's kind of drawn itself out of there.
Until tomorrow.
Yeah, until tomorrow. Till the next day.
And over in the US, so ADP weekly employment change.
Yeah, this is just a weekly figure. There's really not much out today. As I said, the market's going to be looking forward to CPI and the PPI figures later in the week. Don't expect too much from this. This is the kind of, it's a weekly print. It includes the itinerant kind of farm labour, which can see kind of swing up and down a fair bit. Most people don't really pay too much attention to this print itself.
Okay. And some announcements from the banks coming out as well.
The Aussie business confidence and the consumer sentiment, it's obviously going to be good for the local market, but again, any outperformance, expect the Aussie to kind of perform pretty well, but it'll still be pretty muted, I think, because of the it's more of a US dollar story in the markets of these last few weeks. So,
okay. And some big moves overnight. So silver's one that's it's been moving around a little bit recently. Bit of a change here.
Yeah, it's actually just kind of bottomed out. It's hit the previous low. It's sitting at the 200-day moving average and potentially finding a base. Might, if it breaks below and holds there, expect a drawn out move downwards. But if it holds that 200-day moving average, it's probably going to slip back into the range there. As you can see, it's come a fairly big down day, so it's probably due a bit of a bounce, but I guess it's one of those, keep your eyes on it.
What sort of volumes do you think, like comparing, say, silver to gold? How do they compare? I mean, obviously gold's massive, but is silver close, or is it nowhere near?
It's not really anywhere near, but gold is obviously been seen as the store of currency and as a currency in its own right for thousands of years. Silver has sort of as well, but if you're talking about the futures market itself, no, it's nowhere near the same sort of volumes that you're going to see going through there. It's used as a bit of an alternative to gold when it's cheaper, as it currently is, but don't expect it to have as many contracts getting traded in it.
And the Aussie Swiss.
Yeah, I thought this is a pretty fun one to put in there. It kind of just highlights the carry trade between the Aussie and the Swiss. So the Swiss is a bit of a funding currency. Its spot rate, I think, is 0%. It's 10 years at about 0.46 or something like that. So a lot of people will borrow in Swiss and invest in the Aussie because its yield's a lot higher. Our year 10 is about 4.95. I think our spot rate right now is 4.35, but the investable product, that 10-year note, is at 4.95. So you can borrow at 0% in Swiss, convert it across, and then get 4.95%. And if if you think about it logically, if you're yielding 10% on top of that, if you're using leverage, then it's 49.5% for whatever you put in your portfolio. So.
Okay, so and do we see a lot of activity on the carry trades? Is that something clients are actively looking to do?
Our clients will typically not do it on the Swiss. I just thought I pulled this one out because I thought it was a pretty nice looking chart. But our clients will typically go for the yen crosses because they swing around a bit more. As you can kind of see from the Swiss here, it's kind of pretty uniformly just gone up. It's gone like clockwork pretty much. You can draw a pretty nice channel between the down and the top line all the way up there. So it's actually an easier chart to trade. But our clients like volatility, so they tend to get drawn into that a bit more.
And the Nasdaq coming back up a little bit after a fairly big drop last week.
Yeah, had a big sell-off on Friday. Just general profit taking. There's some pretty strong figures out of the US, and off the back of that, the market's kind of taken profit. 2% bounce, pretty decent. I think it just goes to show how strong the tech stocks are right now, and just the US market in general.
Okay. And so was that drop last week? Was that did that have dividends involved in that, or
no? It was just a sell-off. Nothing huge. It was just the market had a bit of fatigue. The whole market is long at the moment. There's just a bit of profit taking coming out of the US. I think some funds flowed from the US to Europe, and a bit out to the yen as well. But no, nothing like dividends or anything like that.
Okay. And some big volatility changes. So the Russell, tell us about this. What is this chart? What is this product?
The Russell 2000 it's the top 2,000 stocks in the US. Typically, what you'll see this referred to is the small cap index because it's kind of an equal weighted index. It doesn't actually it reflects all the stocks kind of evenly. So people will tend to trade it as the small caps because it gets a big dispersion between all the smaller currency names, whereas like the Dow Jones is the large caps, the S&P 500 is a broad index, and the Nasdaq is the tech. This is what's traded for those small ones. So if you want to get passive exposure to smaller companies throughout the US, people will trade on the Russell 2000, and this kind of, as you can see here, bounces a fair bit more than say an S&P 500 would. Yeah.
And the chart of the day, Bitcoin. So we've seen quite a lot of movements, I guess, over the past couple of months, really.
Yeah.
How's Bitcoin looking at the moment?
It's looking pretty precarious, to be honest. I've thrown the Fibonacci retracement out there at the moment. It's just kind of hit the 23% retracement. As you can see, that's an hourly chart. I think I've got a weekly at the bottom of that afterwards. But if it cracks below 60,000, it's going to really struggle to stop the selling momentum, I think. If you just go to the next one, so you can see that it's kind of sitting on the 200-week moving average. It's in a fairly big, drawn-out downtrend. If that keeps going, it's going to be very hard for it to reverse it. Again, maybe you get some more buyers, but it's at about 50% completely from the top to the bottom right now. I guess we'll see what happens with it, but a lot of the crypto flows now are going into actual cryptos that can be used as opposed to the stores of value type cryptos, which is what Bitcoin was meant to be.
Okay. And just back to this first chart,
Yep.
You mentioned the Fibonacci. Can you just explain a little bit more what that means?
They're just the different retracement levels. So you'll have them at 23.6, 38.2, 50, and 61.8 are the typical ones. In a drawn-out downtrend or an uptrend, you'll see retracement back to initially the 23% level, then sometimes the 38. If the trend is going to continue on, it'll probably stop at the 38 and keep going. But if it is going to reverse, it'll typically crack above that 38% and hold there, and then slowly start coming back up. So they're just little different levels for the price to pull back from in a trending market.
Okay, and fairly common for clients to use these.
Yeah, exactly. It's a pretty common indicator. It's one of the major ones you'll see right there on MT, which is pretty readily available that you don't actually have to add in yourself. So, yeah, used by a lot of our guys.
All right. Nice one, thank you.
Cool.
Article of the day. Again, we'll send that one out.
Yeah.
Afterwards. Thank you, guys.
All right, cheers.